Investors, are we looking at a potential red alert because we're seeing red hot inflation and a Federal Reserve that is eager to tackle it? What does this mean for you? What does this mean for the economy? And what does this potentially mean for the stock market? We'll talk about all these aspects and more. If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing. This is a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice. And so let's go through a couple of the main headlines I've seen today that I think investors should be aware of, potentially concerned about, one of which is red hot inflation. Department of Labor announcing that inflation is running at a 40-year high. This has been something that we've actually discussed and anticipated on this channel for some time. Heck, at the last Berkshire Hathaway meeting, Warren Buffett was even talking about how he's seeing pricing pressure. And so this does have a real impact on you, as you would expect, because, hey, your dollars go less distance. You're able to buy less with the cash you have. And so you need to see, a raise in your income in order to offset that inflation. Ultimately, this does lead to social unrest, instability, and so it is something that's important for the Federal Reserve to tackle. You're also starting to see the interest rates in various different financial markets react to higher inflation, in the Fed effectively saying, hey, we're going to let interest rates normalize. You see U.S. mortgage rates surge to the highest level in more than 2 years, even though it might not be a huge figure, going from 2, let's say, to 3%. What you are seeing when you're looking at that is spread across enough people, and that does result in a significant impact in terms of, let's say, the number of people that are going to be buying a house. And whenever you buy a house, that means you're buying fewer goods. Whenever you buy a house, you're buying goods that go in that house. And so if you have fewer people that are buying the house and the goods that go with it, that's a real impact on the economy, and that's going to impact, various different companies and layoffs and what have you. And you're also going to see an impact on U.S. government spending. For example, what you're currently looking at, the U.S. 10-year Treasury is currently above 2%. Interest rate is quickly going higher, and this is going to have really big ramifications for society, potentially the world. And you're even seeing the Federal Reserve talking about considering a super-sized hike. Now, we'll see if that actually happens, but they're considering a 1% increase by July 1st to deal with this inflationary shock. And so, look, ultimately, they're going to defer to Powell on how much they should increase, but it is very clear that they're seeing pressure given these high inflation rates. So this does, raise the question of, okay, so what does this mean for the stock market? What does this mean for the economy? Those types of questions. So for as you look at the economy and the stock market, the big problem here is how indebted the U.S. government is. With $30 trillion in debt, a 1% increase leads to $300 billion more in interest payments. And then that raises the question is, where's the U.S. government going to get that money? And that is really scary, because then you start saying, well, is that austerity? Does that mean you're going to have to take, let's say, a third or half of the Department of Defense budget and cut it and move it to, let's say, covering your interest expense only for, keep in mind, this 1% increase? You start creating real problems when you start saying, well, wait a second, where's this money coming from? Are you just going to have even more deficit spending to deal with this higher interest payment? I mean, that is further problematic. If you have a bad credit or, you have a bad loan, you don't give them more money so that way they can pay off their first loan. That's the problem here. And so moving interest rates just 1%, you start seeing these ramifications. So then, okay, do you have higher taxes? Well, that has a lot of problems too. You see people, okay, we're going to move from high tax states to low tax states. Maybe they move out of the country. They say, hey, we're going to find loopholes to, because we don't want to get taxed at such a, egregious rate. So that also creates friction as members of productive society say, hey, I don't want to get taxed at 50, 60, 70%. So taxation, that doesn't solve the problem. That's just moving the money around. And so then you're looking at, okay, well, could the U.S. government default? No, you can't do that, because ultimately, the U.S. government's debt is the assets of many companies and countries around the world. So if you were to do that, that would be like Great Depression squared. And so then the last, solution, and this is something Ray Dalio talks about, is ultimately you have this part where you see interest rates move higher. interest rates move higher to deal with this dynamic, and it causes a lot of pain, and it causes the economy to slow down. It causes asset prices to get hit, bludgeoned, because as the economy slowed down, so do these companies. They report slower growth. They report maybe contractions in their business. When you have that, the valuations come down. And so as you're looking at all these things, the cyclical companies get beat up. And the reality is, cyclical companies can be really almost everything. I mean, yeah, just think about a major company like Apple, but think about the number of folks that say, you know what, with inflation, I'm no longer, let's say, able to buy that Apple, let's say that new iPhone in 3 months. Maybe I'm going to wait 6 months. And if enough people make that sort of logic, then it does have an impact on sales. It does result in a decline, or making it tougher for businesses to grow or actually post contractions in their business. And so you see this across the board. And so this is why the framework of you see interest rates move higher, resulting in dealing with that inflation, but you do have this structural problem with too high, the debt levels being too high. And so then ultimately, as this is the framework that Ray Dalio talks about, is that ultimately you have the Federal Reserve say, hey, we do a complete 180 and we have to do quantitative easing, effectively infinity, to suppress interest rates and also result in the debasement of the US dollar. And that also creates huge problems and conflicts of interest. And so you're looking at this, and this is just this small change in interest rates reflects a much bigger problem, and it will reflect, hey, what are we going to do about it? That's really the problem, is that it raises that question of how do you deal with, let's say, $300 billion more in interest expenses, let's say over the next few years, because interest rates only move 1%. And keep in mind, inflation rate is way above the current set of interests. The 10-year Treasury is 2%. Inflation's at 7.5%. The U.S. government cannot afford interest rates that high. And so you start looking at this, and it really turns into significant problems for the economy and for the stock market. And so I'm looking at this, and I think it's important to understand various different aspects. One is that long-term, yes, Ray Dalio's right, cash is trash. But in the short term, you can have periods where asset prices significantly deflate because stocks go, wait a second, the economy might really take a hit on the chin because of higher interest rates. So then you have stocks dramatically reset lower. So in those periods, cash would actually hold its value relative to deflating stocks, relative to, let's say, the everyday goods that are inflating. Yeah, you're still losing your purchasing power, but relative to a stock that drops 50%, that's a favorable outcome. So, you do have that dynamic. You also, want to think about what type of companies do you own? Are you owning a highly cyclical business? Are you owning a company that can easily pass on, inflation? Or are you looking at, a company that's less cyclical, doing a product that, needs to be delivered, can easily pass on inflation? So I look at this as a time to upgrade one's portfolio and recognize that for the companies that, let's say, aren't profitable, that are, let's say, higher growth but unprofitable, those types of businesses are going to be extremely volatile in the capital markets, because as interest rates move higher, those businesses really get discounted because their profit stream is from way out into the future. And so you see immense volatility there. And so, and also investors want to actual cash yield in an environment with high inflation, saying, hey, I actually want to get a good payment rate. And so you have all these dynamics at play. And so this, in my opinion, this is a red alert based on these headlines here. I'd love to hear your thoughts, your comments. So please make a point of leaving a comment below. And if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.